Welcome everybody to our webinar about understanding the Main Street Lending Program funding forward. Please post your questions in the Q&A only at the end or as we go along. This will give the Hannah, our moderator, the opportunity to participate in the program. A recording of this webinar and slides will be posted shortly on our community site at realtime.inc.com. Later in the day, we will also email a copy to participants. Sorry, guys. Briefly about myself, I'm Kassar, the founder and CEO of MultiFunding. I'm a regular columnist. I've regularly featured in the press talking about business lending issues. I've advised prior administrations as well as the Federal Reserve about business credit markets. I have a book out called The Growth Dilemma, and for my entrepreneur organization friends out there, I'm a proud member of EO Philadelphia. My lawyers asked me to read some quick disclaimers. We are in an unprecedented time in history, and the information available to us is changing rapidly. Please refer to our most current presentation for education. The information provided is based upon our best judgment about what we know at this time. However, key questions remain about how to implement this program. MultiFunding LLC does not accept any liability as it relates to the timeliness or content of the information we are sharing today or may share in the future, and we are under no legal duty to update any such information or recommendations. We encourage you to check in with your attorneys, CPAs, and financial advisors for additional insights. This is a time for us to be thinking about what is next for our business and reimagining our future. This is a battle, as the world has fundamentally changed with COVID-19, and we are going to all likely have to make some changes. What is our strategy going forward? Are we going to pivot our businesses 5%, 50%, or 95%? What will our team look like? And what ammunition will we need for this battle, or cash? And we will need cash for both offensive and defensive needs. How much cash will be required to get your business back on a stable footing? What is the best case and the worst case scenario? Where will this cash come from, and how much are you willing to personally risk? And what does your future look like, and what opportunities are you considering for your business? These are the veins I'd like you to think about the Main Street Lending Program that is officially live as of Monday and has $600 billion allocated as part of the CARES Act. It is presently in effect until September 30th, 2020, and is comprised of 3 facilities: the new, the priority, and the expanded. Some context. This is not an entitlement program like PPP. This will not be nearly as simple to apply for like the PP program, and will not be offered as widely as the PPP program. If your business has been badly hit by COVID-19, your best chance for a Main Street loan will be through your existing bank that I assume you have loans with. If you plan to use a Main Street loan to expand and grow, more banks will be open to you. You'll get this from your bank. No fintechs or other lenders would be involved. And at this point, we believe there are about 300 banks who will be participating in the program around the country. To be eligible, your business must be established prior to March 13th, 2020. And if you have more than 15,000 employees or 2019 annual revenue in excess of $5 billion, you are too big. You also have to be created or organized in the United States. What is the U.S. eligibility test? An eligible borrower has significant operations in the United States if, when consolidated with its subsidiaries, greater than 50% of your assets are in the United States, annual net income is generated in the United States, or annual net operating revenues are generated in the United States. Subsidiaries of foreign companies can apply. However, you have to attest that you will not send the money out of the country to your parent company. Eligible businesses are partnerships, LLCs, corporations, associations, trusts, cooperatives, joint ventures with no more than 49% participation by foreign business entities or tribal business concerns. At this point, the Federal Reserve is working on a separate program for nonprofits, but it is not live yet. Ineligible borrowers include developers and landlords and other speculative types of industries. There are affiliation rules. So if you are tied to other companies, you have to look at the overall picture, and the overall picture will be considered. An affiliated group of companies can participate in only one Main Street facility, and the affiliated group's loan cannot exceed the maximum loan amount for that facility. There are three facilities that I mentioned. Let's start with the new and the priority. They share some commonalities. They are secured or unsecured term loans with a 5-year maturity. Principal payments are deferred for 2 years, and interest payments are deferred for 1 year. The unpaid interest will be capitalized. Principal payments of 15% at the end of year 3, 15% at the end of year 4, and 70% at the end of year 5. They're priced at an adjustable rate of LIBOR plus 3%. Currently, you can assume that you're going to pay about 3.25% for these loans. Prepayment is permitted without penalty, and initiation fees are really going to be 2%. Now let's talk about the new facility first and what's unique about it. These loans run from $250,000 to $35 million. Let us say that you have a company in row 3 with $500,000 of EBITDA, and the not to exceed amount would be 4 times that, the maximum they could get, and the new would be $2 million. If that company had existing debt of $1.5 million, their potential new facility amount would be $500,000. If that same company in row 1 had $500,000 worth of existing debt, their potential new money loan would be $1.5 million. What's important about this loan is that if you have other lenders and if the company goes bankrupt, the other lenders, existing lenders, have to agree to share the rights in bankruptcy with the new lender. But in the normal course of business, the rights do not have to be senior to the other lenders. These loans can be secured or unsecured depending on what's happening with your other loans. And you are entitled to take other loans after you get this loan, as long as that they don't interfere with the rights in bankruptcy. The priority facilities are between $250,000 and $50 million. They go higher, and they work at a multiple of 6 instead of 4. So to take the same company we mentioned in row 3 with $500,000 of 2019 EBITDA, the biggest loan they could get in the priority would be $3 million. If that company had $1.5 million worth of existing debt, their potential new money loan would be $1.5 million. If that same company had $500,000 worth of existing debt in row 1, their potential priority loan facility could be $2.5 million. What's unique about the priority facilities is that you can refinance other debt into it, as long as the cash flow makes sense and as long as it's from a different lender than you're getting the priority facility from. And the lender's rights have to be senior or on par with all other lenders except for your equipment or mortgage lenders. These loans can be secured or unsecured depending upon what you work out with your lender. On a very baseline basis, a company with $41,000 of 2019 EBITDA and 0 debt could borrow $250,000 under the priority facility, although we don't think it's likely that there'll be many loans done under $1 million. The expanded facilities range from $10 million to $300 million. So these are bigger on the bottom end and the high end. To calculate how much expanded facility you would get, sorry guys, you take 6 times EBITDA minus your existing debt. So in row 2, if a company had $10 million worth of 2019 EBITDA, their not to exceed would be $60 million. If that company had $50 million worth of existing debt, they could get an expanded loan facility of $10 million. These rights on these loans tag along with the existing lender, and they have all the same attributes as the other loans, except the fees to get in are between 3/4 and 1.5%. To get one of these loans, you commit to not paying your old debt off before you pay this debt. You commit not to shutting down your lines of credit. You also certify that you have a reasonable basis to believe that business will not go bankrupt in the next 90 days. You can repay a line of credit, including a credit card, in accordance with the regular line of business, your regular flow of business while you have one of these loans. You can take on or pay additional debt obligations as long as they do not interfere with the rights of your Main Street lender. and you can refinance maturing debt. You do agree to certain capital restrictions while you have the loan and for 1 year afterwards. There are exceptions for S Corp corporations or other tax pass-through entities that have tax liabilities. While you have the loan and for up to 12 months after the loan is paid in full, you agree not to pay dividends or make other capital distributions with respect to the common stock of your business. For those who are earning between $425,000 and $3 million in 2019, you agree not to exceed that while you have the loan and 1 year thereafter. For those who earned in excess of 3 million, so you earned 6 million, you take the delta between 3 and 6, divide it in 2, which is 1.5, you add it to the 3, and your maximum compensation is 4.5 million. You agree to make reasonable efforts to retain your employees while you have the loan, although unlike PPP, that the primary purpose of this loan is not to retain employees, it is to save companies. The lender will calculate, if you're working with a lender you've previously worked with, they will calculate your EBITDA or any adjustments you propose to it in the same way they historically have for you. If it is a new lender, they will have to calculate your EBITDA in the way that they have calculated it for similar companies like yours before. Your debt will include all its outstanding and undrawn available debt, including private and bank debt, that will be calculated on the day of your application. If you have an asset-based line secured by accounts receivable and inventory, it'll be the actual amount you've borrowed that will count, not the amount that you could borrow. How do you compare between 1 to the 3? Let's take row number 2, a company with $4 million of 2019 EBITDA and $10 million worth of existing debt. They could potentially get a new facility of 6, a priority facility of 14, or expanded facility of 14. And they would have to sort that out depending on what they could work out with their banks and how much money they felt they wanted to try and get. Financing strategy, friends, is like offense and defense, and you have to think about both. I want to share with you 3 examples about how different clients we're working with are planning on thinking about using the program. One is a company with a $3 million line of credit and $1 million drawn. This line of credit has a personal guarantee. They are planning on getting an MSLP for liquidity and hope that they'll find a lender who won't require a personal guarantee on the Main Street facility. Number 2 is a professional services firm whose partners will reduce draws by at least 50% in 2020 to recover from COVID-19. They plan to take an MSLP to spread their income hit over 4 years instead of 1. And example number 3 is a company that has already been approached by several competitors who plan to close shop. They plan to acquire companies at pennies on the dollar and use the MSLP money to help. So the time to think how much cash will be required to get your business back on a stable footing, what is the best case and the worst case scenario, and where will the cash come from and how much you're willing to personally risk. And what does your future look like and what opportunities do you want to take advantage of? With that in mind, we are going to ask Hannah to open up the floor to Q&A, and we'll go from there. Please, again, post your questions, any that you have, in the Q&A instead of the chat. Thank you so much.
Thank you, Ami. Is there anything new as to nonprofits on the Main Street Lending Program?
They have some initial drafts of term sheets out, but that's it. Don't be shy, folks. Ask your questions. We like questions around here. Please feel free to ask your questions. You can go ahead and put them in the Q&A.
And where do you apply for an MSLP?
You need to find a lender that's taking applications, either your existing lender or a new lender. Questions are going once. Questions are going twice. You're a very easy audience today. We have a question in the chat. Eligible borrowers, corporations, can they register prior to March 15th? That really depends upon the bank that you're using. And many of the clients who are taking through the program are well along the way, but you don't register at the Federal Reserve. You go to your bank and start the process with them.
When is the deadline to apply for our Main Street Lending Program?
There's no deadline to apply, but as of now, the deadline, the program closes on September 30th. So unless they change that program, it's really smart to get your application in by the end of July, because these are going to take some time. Questions going once. Questions going twice. I think we see something in the chat there.
What happens if we're registered in January 2020, and how can we calculate EBITDA?
Well, I'm assuming you mean register your corporation in January 20. I'm not sure what you mean by that, but the whole basis of this is 2019 EBITDA. So you have to be in business in 2019 and have positive EBITDA in 2019 to be eligible for the program. Any other questions, folks? Questions going once, questions going twice. And that's the end of that. We thank you very much and hope everybody stays healthy and safe. Thank you so much. Take care now. Bye-bye.
Thank you.